There's one question you should never answer at a car dealership. How much do you want to pay per month? Because the moment you say around $600, the dealer knows exactly how to sell you a $45,000 problem disguised as an affordable payment. They can extend the loan, change the interest rate, bury thousands of dollars in add-ons, and still make the payment land right around $600. So before you finance your next car, let me show you the monthly payment trap, how much it can actually cost you, and the exact numbers you should negotiate instead. Buying a car is one of the few situations where people agree to spend tens of thousands of dollars without first asking what the item will cost. Instead, they ask, "Can I afford the payment?" And those are two completely different questions. Imagine you walk into a dealership looking at a car priced around $38,000. The salesperson asks what monthly payment would make you comfortable. You say, "I'd really like to stay under $600. The salesperson disappears, speaks with a manager, and returns with what sounds like great news. "We got you down to $583 a month." You're below your limit. The car is sitting outside, you've already spent hours at the dealership, and everyone is waiting for you to sign. It feels like you won. But let's examine what actually happened. Financing $38,000 at 7.5% for 60 months would produce a payment of roughly $761 per month. Over 5 years, you would repay about $45,687. Stretch that same loan to 84 months, however, and the payment falls to approximately $583. That looks much more affordable. But your total repayment rises to almost $48,960. The dealer didn't save you $178 per month. The dealer moved the cost into the future and added roughly $3,273 to your total bill. You're also making car payments for 2 additional years. That means you could still be paying for this vehicle in 2033, when it's older, worth significantly less and potentially outside its original warranty. And that example doesn't include an extended warranty, paint protection, wheel coverage, theft protection, or any of the other products that can quietly enter the loan. This is why a monthly payment is the perfect distraction. It hides the price of the car. It hides the cost of borrowing. And it makes expensive extras feel harmless. A $2,400 warranty sounds expensive. But describe it as only $34 more per month, and suddenly people accept it. The problem is that $34 multiplied by 84 payments equals $2,856. And depending on how the contract is structured, you may also be paying interest on that product. In 2026, the average monthly payment for a financed new vehicle is around $770. For a used vehicle, it's over $530. And more than 1/3 of new car loans now extend beyond 6 years. That doesn't necessarily mean cars have become affordable. It means buyers are using longer loans to absorb higher prices. You can make almost any car appear affordable if you create enough payments. But eventually, every one of those payments has to be made. So how do you protect yourself? You stop negotiating one blended transaction and separate the deal into individual parts. Before entering a dealership, divide the purchase into 4 separate negotiations. First, the total price of the vehicle. Second, the value of your trade-in, if you have one. Third, the financing. And fourth, any optional products or add-ons. When all 4 are combined into one monthly payment, it becomes almost impossible to know where your money is going. For example, a dealership might offer you an extra $2,000 for your trade-in while refusing to discount the new car. It might lower the vehicle price while raising your interest rate. It might reduce your payment by extending the loan from 60 to 84 months. Or it might tell you that an optional protection package barely changes your payment. This is why you need to negotiate one number at a time. Start with the vehicle's out-the-door price. That is the complete amount required to purchase the vehicle, including the selling price, taxes, registration, dealer fees, and installed accessories. If the salesperson asks about your preferred payment, say, "I'm not shopping by monthly payment. I'd like your best out-the-door price in writing." Once we agree on that, we can discuss financing. You don't need to sound aggressive. You simply need to stay focused. Next, separate your trade-in from the new purchase. Before visiting the dealership, get at least 2 estimates for your current car. That gives you a realistic baseline and prevents the dealership from controlling both sides of the transaction. After the vehicle price and trade-in value have been established, compare financing offers. Finally, review every optional product separately. Do not allow anyone to combine a warranty, protection plan, or insurance product into the loan without showing you its full price. Before signing, you should be able to identify 7 numbers: the out-the-door price, your trade-in value, your down payment, the amount financed, the annual percentage rate, the number of payments, the total of all payments. If you cannot find one of these numbers, you are not ready to sign. Now let's break down the 3 insights that can save you the most money. Never let the dealership be the only source of financing you consider. Before shopping, request loan offers from a bank, credit union, or reputable online lender. The goal is to arrive with a pre-approval that shows your estimated loan amount, interest rate, and term. A pre-approval does 3 things. First, it tells you whether the car actually fits your budget. Second, it gives you a benchmark for evaluating the dealership's offer. And third, it forces the dealership to compete for your financing business. Dealer financing is not automatically bad. A manufacturer may offer promotional financing that beats every outside lender, and a dealership may genuinely find you an excellent rate. But without another offer, you have no way to know whether the rate is competitive. The rate a lender communicates to a dealership may be called the buy rate. The final rate presented to you can sometimes be higher, with the difference creating additional compensation for the dealer. That's why you should never assume the first rate presented is the lowest rate you qualify for. Suppose you finance $35,000 for 60 months. At 6.39%, your payment would be approximately $683 per month, and you would pay about $5,981 in interest. At 7.39%, the payment rises to roughly $700. $17 per month may not sound significant, but over 5 years, that 1 percentage point difference costs almost $1,000. And on a larger or longer loan, the difference becomes even more expensive. When the dealership presents its financing offer, you can say, "I'm already approved at 6.2% for 60 months. If you can beat that rate without changing the vehicle price or adding fees, I'll consider financing through you." Now the conversation is no longer about what payment you can tolerate. It's about whether the dealership can beat a real competing offer. One additional warning: make sure the financing is final before taking the vehicle home. Some buyers leave under a conditional agreement and are contacted later with the news that the original financing was not approved. They may then be asked to accept a higher rate, provide a larger down payment, or return the car. Read the agreement and ask directly, "Is this financing final and fully approved?" A verbal promise is not enough. The written contract controls the deal. The second insight is to choose your maximum loan term before you fall in love with a car. Ideally, aim for 48 months. If necessary, 60 months can be a more realistic limit. But if you need 72, 84, or even 96 months to make the payment work, the vehicle is probably too expensive for your current financial situation. A long loan creates 3 problems. The first is obvious: you pay more interest. The second is that you stay in debt longer. The third is negative equity. Cars generally lose value faster during their earlier years, but on a long-term loan, especially with little money down, your loan balance may decline more slowly than the car's value. You might owe $28,000 on a vehicle that is worth only $22,000. You are now $6,000 underwater. If you keep the car and finish the loan, this may never become an immediate crisis. But if the car is totaled, if your family needs a different vehicle, or if you decide to trade it in, that $6,000 difference becomes a real problem. Some buyers roll their negative equity into the next auto loan. Now they aren't just financing the next car. They're financing the next car plus debt from the previous one. And because the new loan begins with additional debt, they can immediately become underwater again. That is how one expensive car decision becomes a cycle. Before shopping, use a loan calculator to compare 48 and 60-month financing. If the vehicle doesn't fit your budget within your predetermined limit, lower the vehicle price. Don't solve an affordability problem by extending the debt. You should also consider the car's complete monthly cost, not just the loan payment. Add insurance, fuel, maintenance, registration, parking, and a reasonable repair allowance. A $650 payment can easily become a $900 monthly transportation expense. The dealership is only asking whether you can make the payment. You need to ask what that car will prevent you from doing with the rest of your money. The third insight is to treat the finance office as a second sales presentation. You may think the negotiation is finished once you agree on the car's price. But then you enter the finance office and receive a new list of products: extended warranties, service contracts, paint protection, fabric protection, tire and wheel coverage, window etching, theft recovery systems, and gap coverage. Some of these products may be useful for certain buyers, but usefulness and price are separate questions. Never evaluate an add-on based on how little it changes your payment. Ask for its complete price. Ask whether it is optional. Ask what it covers. Ask what it excludes. Ask whether you can cancel it. Ask whether you can purchase it later. And ask whether another provider sells similar coverage for less. If you don't have time to understand the product, decline it. You can say, "I'm not adding any optional products today. Please remove them and show me the revised amount financed." Be especially careful if someone suggests that an optional product is required to receive a particular interest rate. Ask for that requirement in writing. Gap coverage is one product that may deserve consideration if you make a small down payment and would be unable to cover the difference between your loan balance and the car's insurance value after a total loss. But even then, compare prices. Your insurer, credit union, or lender may offer similar protection for less than the dealership. And remember, when you roll an add-on into an auto loan, you are not merely buying that product, you are financing it. If a product costs $3,000 and remains in a 7-year loan, you could still be paying for it long after you've forgotten why you bought it. Before signing anything, pause and perform this final check. Is the out-the-door price identical to the price you negotiated? Does the contract show the correct trade-in credit? Is your down payment recorded correctly? Were any optional products added? What is the APR? How many payments will you make? Is there a prepayment penalty? And what is the total amount you will have paid after the final payment? Take your time. A legitimate deal will survive 10 minutes of careful reading. If someone rushes you, creates a fake emergency, or says the price disappears unless you sign immediately, be willing to leave. The car is replaceable. Your negotiating power disappears once you sign the contract. The most financially powerful sentence you can use at a dealership is, "I need time to review this." And the second most powerful is, "No thank you." If this video helped you understand why a low car payment can still be a terrible deal, hit the like button and subscribe to The Money System. This channel is about making the financial decisions that keep more of your money in your hands, not in the hands of banks, lenders, and companies that understand the system better than most consumers. And send this video to anyone planning to buy a car in 2026. It could save them thousands of dollars before they ever enter the dealership. But avoiding a bad loan is only half the decision. You can get a great interest rate and still buy far too much car. So how expensive should your vehicle actually be based on your income? In the next video, I'll show you a simple formula for calculating your maximum car budget and why the answer may be much lower than the dealership says you can afford. Click the video on your screen. How much car can you actually afford in 2026? I'll see you there.